Hey everyone, Alibaba is set to report earnings on May 14th before the market opens. So in this video, I wanted to preview what investors should look for from Alibaba when it reports earnings. And I'm also going to answer if investors should buy Alibaba stock before, after, or never buy Alibaba stock either before or after earnings. So let's take a look at these results.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so on February 7th, Alibaba's previous quarterly earnings results, they gave us an overview on the strategy they're trying to implement, and they said that their top priority is to reignite growth, the e-commerce business and cloud computing specifically. And I've been talking about Alibaba stock for several years now, and more recently, to start 2024, I had Alibaba stock rated as one of my top stocks to buy in 2024. But one of the risks I've been highlighting is Alibaba's slowing growth rate. It's had a difficult time growing the business. Even though the profits are strong, cash flow is strong, the growth of those figures are not so. And it's interesting that management is now focusing on driving that growth, actually actively looking to drive that growth. So that's good to see. So they said they're going to step up investment to improve users' core experiences, to drive growth in Taobao and Tmall Group, and strengthen market leadership in the coming year. Excellent. So they're stepping up investments to improve the customer value proposition, or as they like to say, users' core experience. If you've been following my channel, you know one of the primary things I look for in a business is the customer value proposition. How good are you as a business in serving your customers versus how good your competitors are at serving your customers, right? And that skill measures, it's a comprehensive measure. I look at how good you are at providing value to your customers. In that, do customers feel like they're getting good value from your business when they spend $10 with you? Do they feel like they got their money's worth? Are they likely to come back? And then the second question becomes, if the answer to the first question is yes, then the second question is, are you doing that sustainably, meaning in a way that generates profit and cash flow for the business? Because there are many businesses that are providing good value to their customers, but they're doing so at significant losses on the bottom line. And so it's unsustainable. They can't continue offering that value because it's killing the business. They're losing so much money while trying to provide that offering. So it's interesting here. I like that Alibaba is focusing on the customer value, trying to improve that, because that will determine if customers come back and spend more with Alibaba. Now, in that recent quarter, revenue grew 5% year over year, which was solid. That's better than what the company had been experiencing for a couple of years. And then the big story with Alibaba recently has been the big share buybacks. They've been buying back billions of dollars worth of Alibaba stock. And I've said that it's an interesting and it's a validating signal to the market that management feels their shares are undervalued. Again, many businesses, many CEOs will go out and talk about how they feel their stock is undervalued, but they won't go out and spend money buying back shares. That's not as valuable as if a company goes out and buys back its shares, spends billions of dollars buying back its shares. That's more convincing that you think your shares are undervalued. So income from operations was down big, 36% year over year. And the decrease was primarily attributable to impairment of intangible assets of Sun Art and impairment of goodwill of Youku. So let me describe what impairment is, and specifically impairment of intangible assets. Companies typically have these intangible assets on their balance sheets. These arise from several instances, one of which could be when they acquire another business. If they pay a value greater than the value of the assets of the business, the difference between those two goes on the acquiring company's balance sheet as intangible assets or goodwill. This goodwill, at least according to US GAAP, then gets evaluated every year for its value. Is it still worth as much as we thought it was when we initially acquired it? And if the answer is no, then you can write down that goodwill. So let's say you had $20 billion of goodwill on your balance sheet and your business isn't growing as well, your prospects don't look as good. You can take a write down. You can say this business is not worth as much as we thought before. Instead of it being worth 20 billion, we think it's worth 10 billion. So then that takes the value on the balance sheet from 20 billion down to 10 billion. It's an accounting adjustment. The company doesn't actually lose that much cash. It just writes down an asset. It says, we thought it was worth 20 billion. Now we think it's worth 10 billion. Okay? So when it does that, you might say, well, why would a company do that? Number one, they are required to in most cases. And number two is because it provides a tax benefit. Now they could say we took a $10 billion hit, and that $10 billion can offset income from other segments. So that's a tax savings. If you have a 20% tax bracket, $10 billion down means you save $2 billion on taxes. So I hope that elaborates on this difficult accounting rule that you'll see companies often do. And this usually happens in times when growth is not very strong. Companies will take the opportunity to write down a lot of their intangible assets and take the tax benefit while they have the opportunity to do so. Still, net cash from operations also decreased by 26% for Alibaba, and the decrease in free cash flow was attributed to an increase in capital expenditure, which is in line with the company's forecast telling and strategy telling investors like, we're going to invest in the business now. We want to accelerate growth, so we're going to invest in the business. That's in line with the strategy. And then several one-time factors, including the timing of an income tax payment and working capital changes related to several of their businesses. Okay. So relating to Taobao and Tmall, the company said that they continue to increase interactive content and broaden the assortment of value for money products, and they continued their efforts to onboard a wider range of brands and merchants. The number of merchants increased by double digits year over year, and this double-digit growth trend has sustained over the past 4 quarters. Good to hear. I want to see more from this 2 segments, Taobao and Tmall, and I want to see continued growth. I want to see these investments turning into results, or the initial results coming from these investments that management said they're going to make. I want to see the results of these investments. I want to get feedback from management. I want to get an update from management when they do report quarterly earnings, the progress of these investments. Are they working out? Did they not turn out as expected? Are you now changing strategy? All of those would be bad news if they said, oh, it's not working out the way we thought, or we're going to change strategy because it's really, really bad. We didn't think it was going to go this poorly. Those would be bad updates. However, if the company comes back and says, look, we made these investments and it turns out it's working out better than we thought. We thought it was going to bring in a double-digit increase, and it's actually bringing in a 40% increase, or whatever the case might be. So that would be encouraging for investors if management were to come back with that statement. Now, in terms of should you buy before or after earnings, the company's stock is so cheap at a forward price to earnings of 8.6. I think investors can buy before earnings. Typically, I caution against buying before earnings because of the elevated risk. I'm sure you all are aware of. Stock prices are more violent around earnings releases. They move more violently. They're more volatile. And so I caution against buying before those violent movements. But when a stock price is as undervalued as I feel Alibaba is, in this case, I think it's okay. Also, it's less risky if you buy half and half before earnings and half after earnings. That way, you decrease both risks, the risk of missing out and the risk of getting in too high. Overall, I still have Alibaba stock rated as one of my top 25 stocks to buy, top 26 stocks to buy, I should say. And I think it's okay to buy before or after earnings. I think both will be a good decision. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.